Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
So, when we look at gamma, gamma is highest for the near term at the money strike and slopes up towards the in the money and out of the money strikes. With delta, the non-textbook definition, I guess I just went through that. Here's the graph. We showed you how that moved, but here's the graph. Here's the graph of gamma. At the money, 15-day, we see we have a large gamma. Over here, gamma is between 0 and 10. If this was a graph of delta, it would probably be between 0 and 1. But now we're looking at gamma, and gamma is a derivative of delta, so it's going to be smaller than delta. And in this instance, we got the stock price at 85. Right here on the red line, the 15-day line, it's much higher up than on the 45-day line. So much wider scope. Now, it's interesting, after it gets out of, when it stops becoming at the money and it gets bigger and bigger in the money, gamma gets smaller and smaller because guess what? Delta's approaching an extreme. Delta can't go beyond 1, so gamma has to get smaller. And on this side of the coin, as it gets further and further out of the money, delta can't go below 0, so gamma has to get small. So this is where you get the most bang for your buck, is at the near term at the money option contracts. Okay, I'm going to keep going through and talking about the Greeks, and then when I come back, I'm going to apply them to different strategies too. So let's go on in and then talk about theta. Theta and gamma kind of go hand in hand with one another, but we need to define theta before we get there. Theta is the amount an option's theoretical price will change for a corresponding 1 unit or day, 1 day change in the days to expiration of the option. Theta is a larger number on long-term options, but maybe a larger percentage of price on the near-term options. Okay, so bottom line is options decay. As time goes by and you have time value in your option contract, it will decay. And if we look at theta, there's a simple little formula that will actually help you out. And let's go all the way back to here. Let's talk about it, first of all. So we have a 1-month option contract. We have a 1-month option contract, and we see that that option contract is trading for $1. Then we get a 2-month option contract. Well, if the world was logical, if an at-the-money option was trading for $1 with 1 month, 30 days worth of time, 60 days worth of time would make sense. It would be trading for 1 times 2, or basically $2. And if we got 90 days worth of time, right, the first 30 days was $1, well, it would be 1 times 3. Now that's if the world was logical. Actually, there is a lot of logic that's involved in the way options decay, and this is actually outlined in the Black-Scholes pricing model. And the answer is okay, is everybody sitting down? You guys ready for this? Options move at the square root of time. I know that's an exciting concept, but this means if you have a utopian world where you have no intrinsic value in the option, it's at the money, so it's all time value. This formula will be fairly accurate in figuring out time decay, or I should say option prices for different time periods. Now we're talking about a 360-day year, 30, 60, 90 days, perfect intervals in between. We would see that if a 1-month option was trading for $1, that second month would be $1.42, 1 times the square root of 2, or basically 41 cents for 30 more days worth of time. If you went out to 3 months, it would be 1 times the square root of 3, or $1.73, which is about 32 cents here in this situation. So if we work backwards towards expiration, we go from a 3-month to a 2-month to a 1-month, we see that it decays slower and then slowly picks up speed as expiration approaches. And we graph that out. So if I look at an at-the-money option contract, and at-the-money is where a lot of this time premium is, and that's why I chose this option contract, we see that over here is the options price. Here's the days to expiration. We started at $1.73, went to $1.41, went to $1, and then wham, my sled hit the tree. It the stock didn't move at all over that time period and it still was an at-the-money option contract, at expiration the option is going to be worthless. Okay, so let's go back and let's talk about a strategy. We've got through the three most important, well, not most, we got through three very important Greeks. And I want to look at, and I'm going to bring up, I'm going to share something with you here. Let's share, let's go in here. I don't want this one second. I'm going to share a desktop with you. And if I go and I look at a strategy, a lot of people like to talk about long straddles. And as a matter of fact, the long straddle is, if you're a beginning option trader, it is one of the most exciting trades to look at. Because if you're a beginning option trader, one of the things about options that is nice is you always say, gosh, I know the stock's going to move, I just don't know which way. And a long straddle, in theory, will profit if the stock goes way up or goes way down. It doesn't really matter the direction. So I'm going to actually show you that real quick. I'm just going to go and jump into our new site that we recently launched called the optionsplaybook.com. So I'm going to share my application, and let's find it here. Okay. So this is optionsplaybook.com, which is a free site that we made available to everybody. But here's the concept of a straddle. The stock is at strike A. We're going to buy a call at strike A. We're going to buy a put at strike A. Now, I told you when we started this event that I'm going to use options not necessarily to try to manage risk like a market maker will. We'll still talk about that concept a little bit later. But I want to talk about this when you're going into a strategy and you're thinking about a strategy. And a long straddle is not the best strategy in the world. I mean, there's no quote-unquote best strategy. But I want to think about my Greeks if I were to do a long straddle. If we were going to do a long straddle and we're going to go out in time, how far out in time do you think we should do the long straddle, right? We think the market's going to move. How far out in time? I want you to think about that for a second. Put a number in your head. I can't obviously see a show of hands or talk, so people can't holler out numbers. And then think about it. First of all, why would we do a long straddle? Normally it's for a news event. So for a lot of people that were answering and saying, oh, we should be out 3-4 months in time, the Greek that you're worried about is called Theta, if you're looking at that situation. Because you're saying, gosh, I'm going to buy a put, I'm going to buy a call, I need to go out farther in time so that I have that slow rate of time decay that Brian just showed me on the last graph. And 90 days out, it's a little bit slower. All right. Now, when you're looking at a long straddle, what happens when the market moves? Let's say all of a sudden the market comes out and the news event happens and the stock starts moving. We'll say it's going to start moving up. Well, if I'm on a longer term option, what am I giving up that's important to the long straddle? Okay, I'm going to say that one more time to emphasize the point. If I go out further in time and I have these at-the-money option contracts, right? I'm buying the at-the-money call, the at-the-money put. What am I giving up when I go further out in time? And I'm going to stop sharing this and go back to the event. All right. Now everybody should be seeing my screen. What am I giving up? I'm giving up gamma, right?
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.